Hey guys, what's going on? January 11th, 2025. Welcome to 13 Market Moves, guys. You come to 13 Market Moves because you're on the lookout for the greatest short selling opportunities in the world to be able to put together 10x, 50x, even 100x trade on short-term options expiration, anywhere from 1 week expiration to a few months expiration. And even for those of you that are hardcore, okay, when it comes to your short selling beliefs, what I'm about to explain to you in this podcast will even be a shocker to you. I'm gonna reveal the easiest trade in the world, which shockingly nobody's talking about, but the charts have already spoken. The move is just in the very innings. So you can utilize the information in this podcast to put a simple 10, 20, possibly 30x trade, because this is absolutely fucking ridiculous what I'm about to show you. And when you're going to listen to this, you're not even going to fucking believe it. Okay. And most of you are going to listen to this and you're going to be like, there's no fucking way. There is no fucking way this is going to happen. But yet it will happen. So here it is. The most overlooked trade right now. I mean, the market is in clear danger. We could be, giving you the 113 bear signs, all that stuff. But like the most overlooked trade is this. The world's safest investment is about to tank some of the greatest companies that are in astounding financial health right now. I'm talking about the biggest world corporations. They are about to tank 50% because the safest investment in the world is about to fail. Maybe not entirely, but to a great extent. Even a smaller size move, which I believe is coming over the course, like near term, over the course of the next few weeks, we could see an astounding move in what is perceived to be the world's safest investment in the fucking world. So what are we talking about? Well, guys, hopefully you already caught a little bit of sarcasm here and you understand exactly what I'm talking about. I'm talking about U.S. government bonds, right? So if you listen to any investor, well, what's the safest way to invest? Well, you buy fucking U.S. bonds. Well, U.S. bonds are total shit, okay? So you may be thinking, well, Leo, that's your greatest idea? You want to short bonds? We've been fucking shorting bonds here at 13 Market Moves for the last few months. Okay, but let's look at the stats, okay? If you're in front of your computer, I want you to pull up TLT. Okay, now TLT is not a perfect representation of the entire bond market because TLT is tied up to bonds that mature long-term, like 20-year plus. But you will find out something that we did talk about in September, when Federal Reserve cut the rate by 0.5 point. And normally when the rates go down, bonds go up. But yet it is that very day when the Federal Reserve cuts the rate by 0.5 point, bonds begin their downward spiral recently. So since Federal Reserve actually began cutting rates in a big way since September, which by the way, if you listen to most of the podcasts here, you should know that was the Federal Reserve admission that they are indeed scared of the fucking stagflation. In July, they didn't say it, but in September, all of a sudden they concede after the August job report of 2024. So the 0.5 point cut was officially the Federal Reserve admission that, oh shit, well, the economy is not, all these fucking revisions that came in August, the economy is not what is being reported, and Federal Reserve clearly understands that they cut the rate by 0.5 point. And instead of bonds going higher, which they should, because typically when you cut rates, yields come down, they don't go up, but exactly the opposite is happening. Okay, so you could say, well, this is a one-time divergence and it's not going to hold. Well, guess what? December 18th, Fed cuts rates again. You would certainly think, well, shit, well, now bonds are going to go higher because, well, now it's like we got, 3/4 point cuts in the matter of, a 100-day time span. And that produces bonds to go lower. So we don't have just the one instance of a divergence maybe holds for a little bit. We have now a prolonged, severe case of a divergence where Fed cuts rates, yields go up, bonds are collapsing. So what's wrong with this situation? Well, I mean, markets got a short memory for a lot of these things, but we don't have to go back very far. I mean, I'm talking about March 2023. Anybody remembers what the fuck happened then? Well, quick reminder, you got Silicon Valley Bank collapsing. Why did Silicon Valley Bank collapse? Well, the answer is quite simple. They thought they could not go wrong by putting their money in the safest investment in the world, which is, in their view, at the time was what? Well, fuck U.S. government bonds. How can you go fucking wrong? Well, you can, and they did go wrong. They put billions of dollars in U.S. government bonds because the money was flowing. They didn't know what the fuck. And that's from like a technology-based bank, right? You think they take the money, reinvest in technology. No, the idiots go and buy U.S. government bonds. The bank collapses. Now, it was not apparent that they were going to collapse until the bonds started dropping in value. Bonds drop in value when interest rates go higher, when yields go higher. So, which is why the current situation is just such a walking contradiction, right? Federal Reserve is cutting the rates, but you can't fool the market. The market is like, there's no fucking way. You should be raising rates, not cutting rates. And of course, the Federal Reserve is not in a position to be raising rates because the whole fucking system would collapse to begin raising rates. So the Fed is in the checkmate. They can't do shit about the current situation. Finally, the market started to get the glimpse of it, okay? So Silicon Valley, Silvergate, Signature Bank, all of them are out because of the exposure to the U.S. government bonds. And now we're talking March 2023. I'm recording this again on January 11, 2025, and I'm telling you that we're about to go through the same thing. Not this time, it's not going to be Silicon Valley Bank or Silvergate or Signature Bank. There's going to be other banks. And by the way, I will record a video or a podcast in the next few days. And if you want to get a list of all the potential banks that could be going belly up, okay, you need to go and put your information at 13marketmoves.com or 13mmtv.com. We'll email you a list of all banks that could be the most magnificent short selling opportunities in not so distant future. But focusing on the main subject, a trade that you don't have to, go and identify particular small banks that their owe exposure to U.S. government bonds. We just focus on the basics. The idea I'm trying to explain you in this podcast is much more simple, okay? So if U.S. government bonds are total shit and they still have room to drop, which, by the way, bonds are now trading at like a 2-year low, but they're not at the 3-year low. If we just look at the chart of TLT, bonds are only down about, 15%. But when you put it in relation to the time frame, it's one of the biggest drops throughout history. As far as the time frame in relation to the size of the drop. We're talking about 15% drop in like 100 days, okay? So it's a huge deal when you look at the size of the move in relation to the time frame of the move. So that's exactly how you get blow-ups like Silicon Valley Bank. It's not the problem that, something in the market drops or something in the market goes higher. It's when something in the market goes exponentially in one direction. For example, dollar continues higher through the rest of, 2025 based off the Trump policies that he's going to be attempting to implement, which, there's some great trades associated with that, by the way, but that's for another podcast. But dollar moving higher, okay, in an exponential format could cause a lot of blow-ups. Not just in the United States, but internationally, okay? But what I'm saying is, for the very first time, we're seeing something that is happening now. And again, this is just the very ending. This is just the beginning, guys. And this is something to, as a short seller, you're looking at this, you're like, holy shit. Oh my God, is this really fucking happening? And it is happening, guys, in reality, because I'm about to give you 3 ticker symbols that will prove the undisputability of this argument, okay? Before we go, and I'm going to give you these 3 simple tickers to make the point, I want you to understand the financial reporting of U.S. bonds on public companies' balance sheet. They're being reported at par value or face value. Okay, so when a big company like Silicon Valley Bank goes and puts $70 billion in U.S. government bonds on their balance sheet, it is reported as them putting $70 billion in U.S. government bonds. But in reality, those bonds, when yields go higher, now they're worth a lot less. But when you look at their financials, it appears as if everything is fine. Well, it's not fine. The bonds are being reported based off how much Silicon Valley paid for them. Now, since Silicon Valley paid for the bonds dropped like 20%. But when you look at the financial statement, everything is fine. When you put $70 billion and the trade goes against you 20%, you know you're in deep shit. But when you look at the financial statement, everything looks fine. The reason being is because the losses don't actually have to be reported on the financial statement until Silicon Valley Bank has to sell them. Okay? So understand this analogy because the 3 simple examples I'm about to show you have the same setup. And I'm just going to use this big 3 because it's for illustration purposes, so everybody can easily understand this point. But this is something absolutely fucking incredible, okay? So basically, if you start looking at U.S. government bonds, not in the form of an asset, but in the form of liability, okay? Because again, where bonds are trading now, we're still only at 2-year lows. We're still 3 points away on TLT from 3-year lows, okay? And it's those 3-year lows that subsequently had SVB Silicon Bank go belly up. Okay, so what I'm saying is we are 3 points away from a level on bonds where Silicon Valley Bank went belly up. Okay? And if you start understanding that the safest investment in the world, that is still perceived to be the safest investment in the world, is actually not a fucking investment at all. It's in 2025, based on the policies and based on the setup, it is an actual liability. Then the ultimate question to ask is, who in the right state of mind, clearly we can talk about Silicon Valley Bank and be like, well, damn idiots. I mean, it's their fucking fault. They should have put it in all the projects, technology projects they were working on. But no, instead they do the stupidest thing in the world. They put it in U.S. government bonds. Well, who else would be so fucking stupid to do such a thing? Well, I mean, there's the shocker, right? How about Apple? Oh, Apple? Apple, whoa, which Apple? Hold on, what's going on with Apple? Why don't you pull up a chart and look at Apple? So there's your evidence point number 1. And yes, we have been short Apple from 258. Caught some good size trades on it. Apple is absolutely collapsing, right? So from 260 down to yesterday was the biggest dropper among all the technology names. Hits a level of 232. Now it's a good size drop. A lot of it clearly could be attributed to the sales dropping off in China. Sure. But we already knew that sales in China were going to be shit. So it's not like that's something new. Okay? We already knew that Warren Buffett was unloading. Look, Warren Buffett was holding $150 billion roughly of Apple a few months ago. Now he's holding only $78 billion or something like that. Basically, he slashed his Apple holdings in half. Like that wasn't a warning sign. But why would he do that? Okay, that is something for you to be asking. But like, if you're looking at Apple chart right now, Something else that we've been talking in a lot of podcasts recently, I said, look, the way you trade 2025 is you focus on stocks that have been overperforming in 2024. And I clearly stated it in the last few podcasts. I said, and you bet against those companies. You actually short the fuck out of those companies that have outperformed in 2024. Oh, there it is. There's your prime example. Look at the fucking Apple chart. It's a gold mine. And what I'm telling you, the main reason why Apple is dropping, it is not because of shitty sales in China, because there's nothing new there. Maybe the magnitude of the sales drop was still a little bit of a surprise to some, but we warned you about Apple sales in China for the last 3 years, and for that reason, that's been our favorite short, and it's got a ton of room to drop. Now, the reason the chart looks so ugly on Apple, particularly yesterday, and particularly like in the last 7 days, because if you look at the chart of TLT, the chart of Apple highly resembles the chart of TLT. And you would think, well, why the fuck would that be? Well, as I mentioned, Apple turns out to be just about as smart as fucking Silicon Valley Bank. Okay? It happens, as of last reporting, that Apple owns 33% of their total assets in treasury bills. Now, again, we just looked at the chart of TLT. Those represent slightly longer term. Clearly, Apple doesn't hold all of their treasury related purchases to U.S. government debt. They're not all 20, 30-year expirations. They hold anything from a year to 5 years to 10 years. There's a variety of U.S. government debt that Apple holds. Okay, and some of these face values been dropping sharper on the longer end than on the shorter end. Now, the question is, how bad is the fucking situation? Well, based on the chart, you know that people are getting a little fucking concerned about it. As you can see, the fucking drop yesterday. But how bad could it actually be? So let's take a look at this. So Apple total assets right now, $350 billion. Apple total liabilities are $300 billion. The question is, to determine how bad things could get, is to quantify, well, what's Apple's exposure to the treasury bills? In numerical terms, it is $114 billion. So you take $114 billion divided by the total assets. As I mentioned, the number is astounding. It is 33%, just a bit shy of 33. So basically, if the valuation of these things that are currently reported as assets at face value were to deteriorate over the course of next few months, okay, there is a point which, simply because the exposure of Apple to United States treasuries are so fucking high, it's 33 fucking percent. We're talking about $114 billion. Do you understand how big that number is? Okay, the Federal Reserve itself fucking holds $190 billion. Okay, Apple holds $114 billion, and that could be the equivalent of like some of the countries that would be on the top 20 list as foreign holders of U.S. Treasury debt. That is an equivalent of how much some countries, okay, how much some countries have purchased of U.S. Treasuries. So the number is ridiculous, not just from a numeric standpoint, but more concerning from the percentage of the total Apple assets. So essentially, now if you're buying an Apple share, you have 33% exposure to the downward spiral in U.S. government bonds. Now, it doesn't become a problem until these bonds are sold. I told you based off the case with Silicon Valley Bank, right? The financial statement looks like nothing is wrong until Silicon Valley has to fucking sell, okay, to cover some of the liabilities. Now, there comes a moment, okay, 114 billion. If this number, okay, if U.S. Treasuries drop in value, I would say another 20% from here, okay, Apple is in deep trouble because at that point we're looking at Apple assets are getting within a dangerous proximity to the size of Apple liabilities. Now, I would go there and say that if something wild can happen, which it can, and bonds drop by 50%, which bonds could drop by 50% from September high. We're already down 15%, which means another 35% drop, which could happen if yields skyrocket to like 10%. I mean, these bonds are going to collapse. This is going to be officially the worst fucking investment in the world, in the history of the fucking world. And then that would mean that Apple assets are now exceeded by Apple's liabilities. Okay? Now, I mean, for those of you that, may not know what that entails, well, I mean, anytime a term of liabilities exceeds assets is used, it's used as a term to describe financial distress. It's used to describe a company that has dangers of bankruptcy risk. It's used sometimes to describe companies that potentially could be delisted from a stock exchange. Guys, there's like, it even goes to the point of personal liability for directors when companies' balance sheet is completely out of whack like this. So all of these things, they sound pretty fucking scary. Nobody in the world would think that such a great company as Apple, who has so much cash. Well, the exception is the form of cash that is often used to describe, wow, the company's so liquid, they have so much cash. Well, what looked to be like a lot of cash until September is now down by 15%. It is just not yet reflected on the financials. Because again, the loss is not reflected on the financial statements until the loss is locked. Until Apple sells these bonds, okay, the loss is never going to show up on the financial statement. So look at the chart. Look at the chart of Apple. The whole story is on the chart. This is what's happening. Now, clearly, there's multiple headwinds, so you could say, okay, but I disagree. It's got nothing to do with bonds. You're fucking crazy, Leo. Nothing like that would ever happen. Apple is not stupid. Well, look, Silicon Valley Bank was considered to be one of the greatest banks, and they went belly up. So I think the case is very, very real here. And for those of you that think, well, Apple just got overbought, the sales are light in China. No, this drop in Apple is not simply due to the drop in sales in China. And to prove the point, okay, let's move on to the next ticker, which is going to be Berkshire Hathaway. Oh, shit, Leo, you didn't go there. Yes, I did. Ticker would be BRK.B or /B, depending on which broker, which software you're using. So look at Berkshire Hathaway shares. Now, I pulled up the B share. I mean, you can also clearly pull up the A share. The B share has a lot more volume, but it doesn't matter whether you pull up Berkshire Hathaway A shares or whether you pull up Berkshire Hathaway B shares, you're going to find the astounding fact that the biggest drop in Warren Buffett's shares happens yesterday. What happens yesterday? Oh, well, it's the same day that Apple falls out of the fucking moon to the proximity with Earth. We had almost a 10-point move in Apple yesterday. How often does that fucking happen? Apple was down like at one point almost 8% on a day. Like, that is remarkable. And for a company like Berkshire Hathaway, that is this, I mean, ask anyone in the investment world, what's the most safest fucking stock out there? It's Berkshire Hathaway. Or not anymore, because if you just do a little bit of homework, okay, you heard a lot of it in the news, right? Warren started dumping a lot of stocks, and what did he do with the money? No, he didn't. No, Leah, he could have not fucking done that. Yes, he bought fucking United States treasuries because according to Warren Buffett, it is the safest, most safe fucking investment in the world. So, here comes the shocker. Warren Buffett holds more United States treasuries than the fucking Federal Reserve itself. Federal Reserve is like 190 billion. Sorry. Warren Buffett, Berkshire Hathaway, officially at like 230 billion? 230 billion? Hold on. So what you're saying, between Apple and Berkshire Hathaway, they own more of United States treasuries than the whole fucking country of Canada? That's exactly what I'm fucking saying. Do you see the big picture now? It is not a coincidence that you got the biggest, best fucking companies in the world that are dropping on the same day when TLT hits 2-year lows. Hello? Do you see the fucking correlation? Well, for those of you, still not enough evidence. Let me bring up the last chart of evidence. Now, there's a ton of charts, guys. I'm just trying to make a quick point and keep it brief, okay? Pull up BLK, BlackRock. Oh, shit. This can't. Wow. If you haven't looked at BlackRock chart in a while, oh, man, you're having a lot of fun. Some of you needed a fucking drink just to look at this chart. You'd be like, hold on, man. I need a chair. I was standing down, man. Hold on, man. I need to sit down here. So, yes, the chart is total shit. Yes, we told you it was time to short at any time BlackRock was above 1,000. Yes, you're making a shitload of money on this trade with us if you traded with the 30 market move scotch. The question to be asking is, why is the $7 trillion Godzilla of the financial markets that is considered to be so safe dropping by such a magnitude, and its chart highly resembles the chart of Apple, highly resembles the chart of Berkshire Hathaway, and highly resembles the chart of the fucking bond market. Yes, you're finally getting the point. This drop yesterday, I mean, it's remarkable. A few drops preceded to that, it's remarkable. But what I'm saying, this is just the very ending of the great move, of the much bigger move. And this is why I wouldn't be shocked to see some of the biggest companies in the world collapse the fuck out as far as their share price concerns. So the problem is dire. It is serious. It is happening now. And it's a big deal. It is way bigger deal than... It is shocking that nobody's talking about this anywhere in the news. Okay? But BlackRock, the $7 trillion Godzilla, I mean, it's in charge of pension funds, and what do they do with the money? They put them in U.S. government bonds, damn it. The bonds are down 15% in the last 100 days. Do you get the fucking point here? And what's going to and you're already looking at these charts the way they look now. Guess what's going to happen if bonds just drop? Okay, forget about the 35%. Forget about the 20%. Guess what kind of chaos is going to take place if bonds just drop just another 5%? Just another 5% could be next week. Next week. All it's going to take is for the yields to shoot back above 5%. And it's not going to take much for a dollar to jump over 110. And what some of you needed to sit down just to realize, oh my God, well, this is not like a fucking bull market that they're telling me about in the news. These charts are, goddamn, looking them red candles. What you're looking at now is just the iceberg of the shit that's about to take place. The exposure of all these big companies to the United States government debt is absolutely astounding. And they may not wait like Silicon Valley Bank to unload some of those positions. Now, let me ask you this. Why do you normally sell your trade? Well, Leo, most of the time, man, I see a red. I see my P&L, man. It's going red, man. I can't take it, man. I can't see the loss. I wake up and it's a fucking loss. I got to cut my position, Leo. That's why I get out. So, do you think Apple doesn't get out of some of their positions if they see their total shit? Do you think Berkshire Hathaway is not going to get out of some of them? Do you think BlackRock may not sell some bonds? And what happens if all three of them sell in the same day? Do you get the fucking point how it is so easy for bonds to drop another 5%? They don't even have to sell much. They just have to sell a little fucking bit. So these are some of the easiest trades, okay? The bad news clearly is to the, millions of people are fixing to retire at 65. That's unfortunate, okay? Because, you're looking, this is the beginning of a 2007, 2008. This is the beginning of 80, 81, 82, 83. This is the beginning of 74, 70, 73, 74 crash. This is how most of the crashes fucking begin. So, what do you think is going to happen to the indexes? Now, here's the remarkable part that I'm not sure how can anyone that is a trader not be paying attention to. You have these big names that I just given you, and that is just to name a few. Apple, but we didn't even touch upon Microsoft and how much shit they hold, okay? If we're going to go for all these companies, big tech, they all have U.S. government bonds in their balance sheet. The exposure is fucking ridiculous. And so as the percentage of those companies in relation to the S&P 500. S&P 500 barely fucking moves. You got a fake strong job number, which, guys, if you were signed up yesterday, we told you before the job number, we said, hey, the outcome is going to be, it doesn't matter. You got shitty job numbers, good job numbers, the market's going to drop. It's exactly what you got yesterday. And you could have owned that position going into the job report as a nice profit, easy profits, guys. But if you missed that, okay, don't miss your chance to sign up with the 13 Market Moves coach by going to 13mtv.com, 13marketmoves.com. Do it today before the market opens. Tomorrow, Sunday, 6 p.m. Hopefully you got your account set up to trade futures because the market will be fucking moving tomorrow night. And the market's going to be moving this week. And the market's going to be moving in a wild way the week after inauguration. And so don't miss those phenomenal opportunities in the market. So what is happening now is something that's never happened in the history of the financial markets. And if you focus on those charts I've given you, okay, indexes have not dropped off yet. They have not dropped off yet. The companies like Apple, Berkshire, Microsoft, BlackRock, Goldman Sachs, they are all fucking making expansion moves to the downside, but yet the indexes themselves, I mean, okay, we get a little drop on NASDAQ, 400 points intraday. What's the big deal? Okay, well, the big deal is that indexes themselves have not dropped off the cliff yet. We have every side in the world pointing the indexes are about to fucking collapse. These big companies are about to drop. Yes, they're the safest companies, but they're the most owned companies, and they have the largest exposure to U.S. government debt. So, welcome to 13 Market Moves 101. I hope the information laid out in this podcast makes sense, but more importantly, will you use this information to put together your next 10x, 20x, 50x, or even a 100x trade utilizing short-term options expirations. If you want to do something which 99% of the people will not do, and that is short the market right before it collapses the fuck out, in a way that can produce those crazy fucking returns, okay, of 10, 20, 50, 100x on some trades, then the only thing you got to do is understand the 13 Market Moves formula, understand the moves, and trade them with the 13 Market Moves coach. It's that simple. The markets have never been easier to read than they are right now, guys. You come to 13 Market Moves. If you want to make money while the rest of the world is going to be losing their ass, the choice is yours. You can certainly buy calls in the face of everything that I have just described in this podcast. But the money is going to be made on the downside. Option premiums to the downside are about to fucking explode. The question is, do you know which one of these trades is going to go 10x? Because you could be utilizing the information in this podcast and you can easily just go buy some puts. And yeah, sure, you're going to make some money. Sure, you're going to maybe make 2x, 3x. But will you make 10x? Will you make 20x? Will you make 50x plus? That's the question you should be asking yourself right now. Will you really be wasting an opportunity like this? So I hope you make the right decision, and the time to make that decision is now, on January 11th, 2025, before shit is going to completely get out of control here. You got to buy your options ahead of the big move. So get in touch with the 13 Market Moves coach today, 13mmtv.com, or click the link below this podcast or below this video. And take action now, guys. Let's roll. Big fucking trades. History is made.